Good afternoon. This Thursday, January 15th. Make sure you get your quarterly estimates in today. Well, activity today tied to the soybean pit as a couple things came out today, and I'll get to that screenshot here in a little bit with South American production for Brazil as their USDA equivalency put out their numbers today. And also, we had the rumors that Reuters put out a story that rumor has it we're going to see finally some announcements from the EPA in early March where they're going to rule on the RVOs likely at last year in June, the levels they talked about that we would go for increased production for biodiesel. But the give up sounds like in the RINs where they're going to still allow importation of used cooking oil like from China, which hopefully is not full of just Indonesian palm oil. And so that is kind of the trade-off, but they argued that if they don't allow that, because some areas could be pinched for available supplies, it'll cause dislocations and higher prices, which would not organically grow demand for biodiesel. So that should be coming in early March, and that helped cause the bean oil market to shoot sharply higher today, of course, giving our bean pop up to the, what was it, the $10.58 value. So we'll get to that in a second. So right now, let's take a look at what Brazil's version of the USDA put out today. Brazil, on production, they lowered pretty much almost a full metric ton. I can't use my pointers here, but if you look at soybeans here on the top side, lowered production by a total of 1 million metric tons. That's because they lowered their bean acreage by some 263 million hectares, which is the equivalency of some 650,000 acres. So the bulk of that was from the acreage reduction as opposed to the USDA's acreage increase on corn via harvestable silage acres. Now, soybean yield down slightly, so it was all pretty much on the acreage, but that also helped support beans at one point today. So now let's drop down and take a look at Argentina, where, of course, they're wrapping up on the bean production planting, and in the areas of the north, it's growing. But take a look at this. This is the forecast out through Sunday, June 25th. Days of heat will already be starting to layer in. This is what it's going to be like starting next week, Saturday, for days on end. This is the GFS temperature. This is 100 degrees, 104 exactly in some areas. If you look at this scale, 40 degrees Celsius is 104. We've got a lot of this developing here. Now, not necessarily going to be 104, but it's going to be hot. Let's just put it that way. Down in Argentina, a week plus from now, today is the 15th. This is 10 days out on the 25th of January. Here is January through Saturday, January 24th. Not much moisture in Buenos Aires, down in that area where the heat is, also in the north, moisture starts disappearing, where, of course, we'll be getting closer to their pod filling time. What is this? This is the 27th. This puts us out towards the 10-day window. Again, not much moisture in the north. And then, of course, Buenos Aires, it's more in the southwest. And truly, really, what does this develop when we're talking 10 days out? Now, to be fair, here's the euro, who's been wrong consistently as of late. It tries to bring more moisture in on the 10-day, and you literally have to go out 10 days to see it. It always has moisture in that 10 to 15 day, and it just never makes it in. So something is developing down in Argentina. Now, we've already tweaked the acreage down from Brazil themselves on total production. That takes a hit on the USDA numbers as well because they'll follow their acreage lead. And then we've got South America, Argentina, a third of the bean production as the Buenos Aires area could cause us to not make trend line. And of course, that lowers the yield. If you're getting value from this video and want more, just check out our daily newsletter. Each morning, we send a market summary to start your day, plus deep dive analysis, trade alerts, breaking news, and videos just like this. Whether you're a farmer, trader, or just tracking the markets, it's a great way to stay ahead. Start a free trial by scanning the QR code on screen or clicking the link in the description. Call us at 701-222-0221 or visit heartlandinvest.com. Now we take a look at the bean oil, which was the fire today. We had long ago said how wave 2, we never did close below the low of the November low, and so that kept wave 2 in play. And look at the firepower we're getting. We are longer term of wave 3, but we were in wave 3 higher. We actually spec bought a bean oil last week, took $300 on it to reduce risk going into the crop report, let the wrong one go. Should have dumped a corn and let the bean oil ride. Well, that's how it goes. So that's wave 3. Wave 4 pullback here could still occur for a final wave 5 of 1, and then we get a bigger correction, and then we try it again. So that's bean oil, who is our leader. Of course, soybean meal is the loser on this crush issue. By the way, the bean crush today, strong soybean crush was above average guesses, and bean oil supplies less than thought. That helped boost soybean oil through the day. So soybeans today on the continuation chart, stopping at the 200-day moving average for the high today, 1058, before chilling for a bit. What we want tomorrow is a Friday close above 1045. Today's 52.5. Close above 1045. You close above the prior week's low, and you stay above this more aggressive trend line off of the fall lows. I mean, note, if we go back farther, we can take the 2019 low, the 2020 low, and it scored the 2024 low, double bottoms there, and the 2025 low. Cute, isn't it? So we get through this week and further strength develops, something's going on. I think Argentina weather will start to take hold. And there's rumors that Brazilian yield production is being put into question. Maybe some areas too much rain because, frankly, soybeans don't like wet feet. So we'll see how this plays. Technically, beans are looking encouraging in here. Now let's go to corn. Now, before we talk about corn flat, this crazy chart I'm going to show you in a second as we talk about it, this is the Dalian corn chart as compared to the U.S. corn chart. The green line is the U.S. corn pricing. The bars are the Chinese pricing. What we have and what you're looking at is corn is at 6-month highs. Whereas when we look at the corn for U.S., we're at 5-month lows. And that doesn't last for long because the last time this occurred was in 2020, when corn prices went vertical because China stepped in and started buying up our corn like crazy, and the USDA was missing it all fall. Now, let me tell you what's going on here. The USDA rubber stamps a communistic country's number for corn production and believes it. When they had a horrible, hot, dry window during early corn growing period of the year into pollination, and then they had flooding occur, not just heavy rains, but flooding during the harvest. And we're to believe that their yield production and end carrot is as high as it is. Yet, to believe that, then why is their corn at the highest price in 6 months, and our price at the same time is at the lowest price in 5 months? Something's going to give. Well, China doesn't get a new corn crop for another 10 months. So the odds of their prices coming off following us are low. The odds of their prices rising further and ours being pulled up by them, possibly by China buying U.S. corn, they've done it before. They can do it again. They seem to be on better terms with President Trump, and that could be the shift in the carryout. They come in and buy just 8 million metric tons of corn. Carryout is back below 2 billion and on its way to 1.9 billion, especially if they went for 10 metric tons of corn, million metric tons. That would be something that changes the game here in the short term. So again, here is the corn Dalian exchange in China. They're near their best levels in 6 months. And here's our corn chart at our worst levels in 5 months. Something's going to give. That's why we think we have a wave 2 in here, holding at least last August's lows at near 410 if we have to slip through the 78% retracement by much and create some kind of saucer low. Look at the continuation chart. The December contract, which doesn't even exist anymore, made a low at 409 3/4, making 410 an important level, which is also the March contract's important level. So something in here developing. I think it's China maybe buying corn in the future. And of course, we've got to get the safrinha corn crop planted in February and March and off to a good start and make sure that gets pollinated in the month of May and June. Crude oil today, back under our moving average, our 77-day moving average. That spike higher could have been the culmination of an A, B, C up here, wave 2. And now maybe we're starting a wave 3 lower as President Trump has taken away the threat of Iran. being pursued militarily. That allows us to soften up as production numbers for the U.S. this week showed a build in oil stocks rather than a draw than what many were expecting. And of course, production sales out of OPEC continue. Venezuela is going to be a long time until that ever becomes something of a story. That's at least 6 months out. But in the meantime, there is a trend lower that should likely have us pressing to the downside on crude oil again, back towards $55 a barrel at least, and then going to just at minimum a sideways trading range until we decide what's next. And finally, we're going to wrap up with cattle. Live cattle stalling out, not putting in the performance that feeder cattle did today. Feeder cattle made new recovery highs, whereas cattle live made their highs last week. And today we had a minor recovery, worried about whether cash trade is at least steady this week at 232, maybe 233, and February doesn't want to get ahead of itself. I do believe in another week the April contract will come on, or it's already going to be next week. Cattle on feed report next Friday. Inventory report at the end of the month on Friday, January 30th. And so we'll be looking at April cattle, which is a bit higher than the Febs will be coming on the chart here probably next week. On the feeder cattle, did push on through, got us right to this 365 value, 364.90, which is the 786 Fibonacci retracement of this whole collapse that occurred. And of course, I've been saying 370 could be challenged in this whole thing, as I believe there's a possible left shoulder, head, right shoulder development on this chart. I know the sale barns are on fire. The light calves, 400-pound calf. If you bought that calf today for what they're paying now in areas in South Dakota and other states, you need 279 to break that calf even. I've learned one thing in my 40 years in this business. The cattle buyers will always own the highest priced pen of cattle before the market breaks and as the market breaks, because they still can't see the turn. They always are bullish and stay bullish until, just like this, the cattle buyers were bullish all through that. That hurt. $80 break. And of course, they're vindicated. The market is tight, and we are in the tightest quarter right now. But let's keep in mind, Brazil has now struck a deal with Mexico. We're going to export less beef to Mexico. That was always our trade-off. We would take 100,000 feeder cattle a month and then turn around and send them beef back. While they just eliminated the tariffs on Brazilian beef, they'll start taking some Brazilian beef into Mexico, and Brazil got hit between the four eyes from China. China will only allow them to send them 1 million metric tons of beef a year, not 1.7 million in their quota. Anything above 1 million metric tons, that 700,000 metric ton difference is now hit with a 55% tariff. Well, in the U.S., Brazil now hits a quota that they usually fill in the month of January, February, and the rest of the year they pay a 25% tariff. Well, they'll rather pay a 25% tariff than a 55% tariff and let the price of their beef, which has been lowered by Chinese announcement, find its way in the U.S. a lot easier than before. This takes time to realize because it's actual facts of what is moving around out there. And I think that's something that, along with the Mexican border, becomes a risk to this feeder cattle market later on this year. But on January 30th, it's going to be the inventory data. So we'll see how that plays out. This is Eugene Grainer with Heartland Investor Capital Management. Hope you find this information useful.